Let's process an example of situation number 2, which is the drawings of assets other than cash. And before we do that, we've actually been doing drawings for quite some time now. So let's take an example we can already do. Example number 1, drawings of cash. On May the 4th, the owner of the business withdrew cash of $1,000, and we've got an ATM receipt there. Well, we've been doing that for a while. We created a ledger called drawings, which is a negative owner's equity. So when it goes up, it's a debit. And then on the credit side, we've got the bank of the business going down $1,000. We do a narration, drawings of cash by owner, ATM receipt 101. And then we'd post that to our general ledger. We had a debit to drawings and a credit to bank. So simple, we've been doing that for quite some time. All we're going to do now is change one thing. We're going to say instead of cash, it's a drawing of an asset other than cash. So in this case, the owner of the business withdrew inventory with a cost price of $1,100 including GST, memo 2, and the business sells all inventory at a markup of 100%. So now we've got to figure out, firstly, do we use the cost price or the amount we would have sold the inventory for? Well, when we're taking out drawings, we're always taking out drawings at the cost price of the asset. So we can ignore this markup. That's what we would have sold it for. So we would have doubled the price, but that never happened. It hasn't happened yet. So that's irrelevant. It's just there to confuse you and try and get you to make a mistake. So we're going to ignore the markup. So now it comes down to the cost price. Now that's got GST. Do drawings have GST in them? They don't. So we want to get the GST out of this. So really, to cut the story short, the owner withdrew inventory which cost $1,000. So that's once we divide by 1.1, we'll get 1,000. So let's do our debits again. We do a debit to drawings, just like we did before. And all we're going to change is the account that we do the credit to. So last time we did bank, this time we're going to do inventory, change our narration, drawings of inventory by owner, memo 2. And then we post to our general ledger. So we've got a debit to drawings, just like we did before, and a credit to inventory. So the only change here was instead of going to bank, we went to inventory, and that means we would need to change our reference here for drawings. So if we could sort of look at a comparison there, for the first one, we had the withdrawing of cash, we had debit to drawings, withdrawing of inventory, debit to drawings, exactly the same. So the only difference was this credit here. In this case, when we withdrew cash, cash went down. In this case, when we withdrew inventory, inventory went down. And then with the narration, obviously the description was different, but most importantly, we get the source document number right. So here we had ATM receipt, and here we had memo. So the final thing we might need to know is what is the impact of that transaction there. So we've got drawings of inventory for $1,000. What's the effect on the balance sheet? You can do this in any order, but remember what's important is that your words balance. Assets must equal liabilities plus owner's equity. When I do it, I just go through the entries one at a time and then put that in the table. So for example, I've got drawings going up, so that's a debit. And when you think about it, drawings is a negative owner's equity. So it's going to decrease owner's equity by 1,000. So I've dealt with that one. Now I've got this one. This is a credit to an asset. So that decreases assets by 1,000. And that's it. We've got no effect of liabilities. But then we get that question which says, well, what if it was not recorded? Well, we just flip it around and we say, well, look, assets should have gone down 1,000. But if they didn't, they'd be too high. Or instead we use the word overstated. Now, liabilities wouldn't be affected one way or the other. So we just write no effect. And then owner's equity should decrease 1,000, but it didn't. It's too high. It hasn't gone down. So we would use the term overstated by 1,000. And what we remember is make sure our words are balanced there. So we've got assets overstated 1,000 must equal liabilities, no effect, plus owner's equity overstated 1,000. Our words balance, and we've got that one correct.